Okay, the next problem on our list is CP91. CP91 says at the beginning of the year, Young Company bought 3 used machines from Vince. The machines immediately were overhauled, installed, and started operating. Because the machines were different, each was recorded separately in the accounts. By the end of the first year, each machine had been operating 7,000 hours. The requirements, part 1, compute the cost of each machine, explain the rationale for capitalizing or expensing the various costs. Let's stop there and work that part. So I've done this problem for you in Excel. We've got various different costs associated. So they gave us some data here. They said there was amount paid for the asset, installation costs, renovation costs prior to use, and repairs after production began, right? Well, when we look at the items that are necessary and reasonable to get the asset ready for its intended use, that is the standard of what we capitalize, right? We find that these 3 costs were absolutely necessary to get the asset to be used. If we look back at the original information, it says the machines were immediately overhauled, installed, and then started operating, right? So we purchased it, we installed and overhauled it, and then we started operating. So these are the costs that we actually capitalize. These ordinary repairs, the repairs after production began, this doesn't extend the life or the usefulness or the capacity of the asset. Therefore, we don't capitalize it because there's not multiple periods that we need to recognize the benefit over. These are just period expenses. These are expenses that we incur in that period to keep the asset going, but it doesn't extend the usefulness or the life of the asset, right? So if we add up all these purchases, and the purchase price and the installation cost and the renovation cost, I've simply dropped these numbers in here, right? We just add those up and we should get the total amount that we're capitalizing. So I put a sum formula in here again. You just add those up and you get the total amount that's going to go on the balance sheet. Capitalization means placing on the balance sheet, right? Deferring that cost until you can recognize the expenses with the revenues, matching the expenses with the revenues that that asset generates, the benefit or the use that asset gives you. Same with part B, same with part C, just adding these costs up, okay? On part 2. Part 2 says, give the journal entry to record the depreciation expense at the end of the year 1, assuming the following. They give us 3 different depreciation methods. Remember that these assets, each equipment was seen to be its own type of equipment. It was different. And so each one has a different depreciation method, assuming that it best represents the use that they're getting, right? So the costs that we have here, these are simply linked to what we had up here, right? Whatever amount we said we're going to capitalize, that's the initial cost of the asset. So that's the cost that we're depreciating. We then subtract out the residual value to get the depreciable basis. This is the part where we actually use for our calculation, right? This is the part that we actually depreciate upon. There's one thing I want to mention, one caveat I want to mention here. For depreciable basis, for the straight line method and the units of production method, it is simply cost minus your residual value. But for double declining balance method, machine C, right? The depreciable basis is not cost minus residual value. It is instead net book value. Net book value is the actual amount that we're going to use in our depreciation calculation. Net book value is cost minus accumulated depreciation. However, we're doing this on year 1, which means accumulated depreciation is 0. So you can tell by pressing F2 again, you can tell that the cost is simply the same as the net book value in this first year. We haven't subtracted out residual value. I just put it in there for consistency purposes. Okay? Once we have the depreciable basis, we then consider the useful life or the rate that is being used and calculate out depreciation. Again, these amounts were simply given to us, right? So, for straight line basis, we use 1/5, or we can take this amount, the total depreciable cost or basis, and divide by the useful life, because it's going to be the same as multiplying times 1 over the useful life, right? And so that gives us a total amount here of 1,740 per year. Same, we're just calculating year 1, but it's the same every year. All right, units of production method. Units of production method, we simply take the depreciable basis and do one of 2 things. 1, divide by the useful life. In this instance, it's number of hours, right? So the units of production is the amounts consumed, the units consumed, or the units made, right? So in this instance, how many hours is it going to run over its useful life? Well, I've taken 26,400 divided by 40,000. That gives us a rate per hours used The amount of hours that said that it used in the year 1 is 7,000, so you multiply that by 7,000, and it gives you 4620. Double declining balance method. Double declining balance method, we simply take the net book value, which is 10,800 because there is no accumulated depreciation in the first year, and multiply out times the rate. In this instance, the rate is 2/6 or 1/3, right? Because the useful life is 6, right? Notice these depreciation methods are all different, and so are the assets' useful life, okay? So just because we're using straight line method, I know that double declining balance is twice the straight line, but don't be confused. We're not using 2/5 here because this has a different useful life. The straight line method for this machine would be 1/6. So the double declining balance is 2/6. So you multiply that out, or divide that out, you get 1/3 or 33.3%, right? And then you multiply that out times the net book value, 10,800, and you should get 3,600. So I've written the journal out here for you, taking each individual asset and giving its own accumulated depreciation because they said that they were all unique, right? This is generally how it's done in practice as well. You will separate accumulated depreciation out based upon major category of asset, like buildings will have its own depreciation, accumulated depreciation. Equipment will have its own accumulated depreciation, etc., etc. And depreciation expense, typically it'll be one lumped account. You'll have a depreciation expense lumped account, you'll have amortization lumped expense account, right? So if you sum all these up, you get the 9,960 and record the journal entry. I'll post this online again like I do with all the problems I solve for you in Excel. But if you have any questions, you can of course email me as well.